We're going to take a look at a 20-year technical analysis of Amazon, and we're going to look at stock market stocks. We're going to use some technical analysis of stocks, and specifically we're going to use moving averages to take a look at this stock, and we're going to show you what you could have done with moving averages to make a lot of money in this stock and use the moving averages as tools to stay with this stock. So we're back here almost around 20 years, 2002, and we're looking at moving averages. Now there's three of them on here. You can see the green is the 5 bar, the red is the 20 bar. In a minute I'll show you a blue 200 bar moving average, and this chart we're looking at is Amazon.com, and it's a 1 month chart. That means each bar is 1 month, and we're going to switch to a weekly and a daily in a minute, but let's take a look at what we got right here. So we go back to 2002, and let's say you just bought Amazon down here for in the pennies, under $1, right? Let's say you paid 50 cents for it. How do you stay with this stock? Well, the first thing you have to do is make a decision to stay with the stock, and that's extremely difficult. I have a friend who trades stocks, and he calls it the money drop. As soon as it goes up, doubles, triples, he takes his profit, and there's not really anything the matter with that. It's just if you'd stayed with $10,000 worth of Amazon stock from the early 2000s, it would have been worth $30 million at around 2020, 2021. Now, is that unusual? Yeah, it's extremely unusual, but I'm going to show you with technical analysis how you can have a really good idea of how to stay with the stock. Keep in mind, there's a lot of other ways you could have done this. You could have done it fundamentally, doing your fundamental analysis on it, but the technical analysis of stocks and technical analysis in general, especially using very simple moving averages, is a way to look at a stock and make an objective analysis of whether you should stay with it. And in the background, you always have to pay attention to the fundamentals. This chart doesn't tell you that Amazon was leading the charge on the internet for retailing, and of course that would have had a huge impact on your decision to stay with the stock. So keep in mind, we're looking at it from one perspective, which is the technical analysis of stocks. So let's take a look. We start here first, and again, this is a monthly chart. So from here to here is 2 years. And we're going to just take a quick look and see, you bought the stock, let's say you paid 50 cents for it, and you decided to stay with the stock, and you were determined to keep it as long as you could. Well, you paid 50 cents in here, now it's already valued up to $3. So you got in it, let's just for starters, let's say you bought it for 50 cents back here in January of 02. So now by October of 03, you've made roughly 6 times your money on the stock. So, you know, if you paid $10,000 for the shares, you bought 10,000 worth of Amazon, now it's worth 60 grand. Most people are going to cash out of that. It's a great trade. But the reality of the situation is, if you looked at this on a monthly basis, you would have seen that this distance between the top of the bar here and the bottom of this moving average had gotten away from where it had been. And this area right here, when you're using moving averages, is the critical component that I want to show you over and over and over again of how you can determine that a stock's overbought and is likely to fall off, and you can either stay with it or get out of it and get back in it again. It depends on what you want to do. My recommendation is that you just understand it, and then you have to decide for yourself how you want to trade the stocks. But you can look at this stock and see that as this white space between the red line and the price grew, this stock became overbought. And as it becomes overbought, there's a much higher probability this stock's going to sell off. And that's what it did. Now keep in mind, each of these bars is a month. So you're talking about this stock was overbought in October of 2003 and didn't fully correct at least until April of 05, and really bottomed out in August of 06. That's a long time to be in this stock when it's headed down. But the rewards are enormous, because here was $3. But if you stay with this stock, understanding this is just a correction, then you get up here in 07, now you're at $5. Could you have sold this stock here, made 6 times your money, and bought back here at $1.30? Yes, you could have done that, but would you have done that? Most people would have sold out for $60,000 profit and spent it. So if you'd have left your money in here, and this will become more obvious as we move forward, if you'd have left your money in here, you would have realized the stock had simply got overdone, and now it's just working itself out. Because after all, you only paid 50 cents for the stock. You're still way above that. You're still way in the money at $1.30. So your patience would have been paid off, and by October of 2007, the stock would be $5. But you'd see, oh no, look, same thing's happened again. We've got this huge amount of space under the price compared to the 20-day moving average, and we're due for a sell-off. So you could have done a lot of things. You could have sold the stock and made, what is that now, 10 times your 50-cent entry price, right? It's trading at $5. It would have been 10 times what you paid for it. You could have done that. Or you could have sold puts against it and hedged yourself for a decline that was almost inevitable. You would have known that because of this great distance between the 20-day moving average. Now we're going to switch to a 200-day moving average here in a minute, but on these longer term charts, a 20-day moving average is sufficient for you to see that whenever this gap here, this huge white area, gets bigger and bigger and bigger, just like it did down here, you're due for a correction. And you can see we've got a huge correction and went all the way back down to $1.73. So that's now November 8th. So you took a huge beating. You went from $5 to $1.73. Most people are going to be shook out of this stock at that point. But look what would have happened if you stayed in. Keep in mind your entrance was 50 cents. If you'd have stayed in this stock, you would have had an unbelievable reward. You could have stayed in this stock, and once you got above the 20-day again, now you can sleep easy, and you can see that every time you get some space, you sell down to the 20. You get more space, you sell down to the 20. You get more space, you sell down to the 20. And that's continued on and on and on here as we move up in price. Notice now that this previously, the stock really wasn't in an uptrend. Now the stock, and you can see here's our 200-day moving average, this blue line. Now the stock is clearly in an upward trend. We're still using a monthly bar, but you can clearly see that as we scrunch this in and try to see it a little better, you can clearly see that every time we get a big gap of clear white, we get a correction. But in general, we're still in an uptrend. We have a upsloping 20-bar moving average, right? And we're still in an uptrend. So sure, we get these sell-offs. This is a big sell-off right here. You're at 42. 2 months later, you're down to 35. But you're just correcting this space here. You're filling it by dropping back close to the 20-bar moving average. And again, here, get too much space, you drop down a little bit. And you can see here, on this type of chart, on a monthly chart, you can use a 5-bar to help you sleep better at night. You can clearly see in this move here that it's in an uptrend. Each one of these is a month, and you're just doing nothing but sitting back and raking in money. You go from about 73-ish to 101. You know you're going to get a correction because look how it's widened out here. Look at all this white space that's gotten bigger and bigger and bigger. You collapse right back down to the 20-bar moving average, and so forth. You overbought, so you're going to go flat for a while, and that's exactly what's happened. Same thing here. You're overbought. You're going to go flat for a little bit. Now this is where it gets, at times like this is where it gets really tricky. So I'm going to switch to the weekly chart. On a monthly chart, you can see this stock went flat, but when we switch to a weekly or even a daily, because now at this point we're just before the pandemic right here, and you've made a ton of money in this stock. All kinds of things is going on in this stock, and you've made enormous profits in this stock just by hanging on to it. But now we get issues with what's going on with the market, what's going on with the fundamentals of the stock, because now we're 20 years ahead. We've managed to hold on to a 50-cent stock for 20 years. We're now worth millions of dollars just in that stock. We bought $10,000 of it, and we're 20 years down the road. How do you know to get out of this stock? Well, the first thing you'll notice is we're no longer in an uptrend anymore. We're now flat. We're essentially around $165 in this stock for, what is that, July 20th all the way to December 21st. So more than a year, we're oscillating around $165. Now, you could have said the same thing right here. And, you would have lost the last part of that rally, but you would have lost the last part of the rally. In a minute, I'm going to show you a different time period that would have helped you and made it a little easier. But notice, even though you were here sideways, you never really had a significant close below the 20-day moving average, the 20-period moving average. That would have been a huge indicator to you to stay with the stock. It didn't close below the 20-period moving average. The 200 period moving average here is not a huge help to us. You'll see how it helps when we go to a daily and a weekly chart in a minute. But you did go sideways, but you never closed below it. Now here was when you had a real serious problem with this stock. You'll notice it went sideways for a year on a monthly chart, stayed above the 20 bar, but we had a close right here, January of 2022. We had a close right there of below the 20-day moving average. And if you look, you had to go way back here, probably till January 15 to get one of those. And that was your indicator of a real serious problem. And if you'd have told me, hey, I sold out on this rally here because it closed below the 20 period on the monthly chart, I would have said that was a sound move. But the point is you do have very subtle indicators like these spaces that you're going to go flat or get a correction. These exit points, when you finally do want to exit, are much harder, but they are objective. We had a close below the 20 bar moving average for the first time in over 5 years. So that's how you can use moving averages. Now let's use them to stay with a stock. Let's go to a weekly chart and see what that does for us. Now you can see that the 200-day moving average is starting to help us out. Let's go back to January of 2022 and see if we got anything better there. Not really. This right here is January of 2022. Using a weekly chart, we didn't get a whole lot of help. We certainly got it on the monthly chart, but you can clearly see that we were flat, just like we were on the monthly chart. And you can clearly see at this point, you're all the way down to 127 from a high of 188. So this is a 200-day moving average. Didn't help you a whole lot to time you out of there. The monthly really did. Let's see what the daily does. We could go to a 1-day chart here and let this populate. And now we see a much bigger help on a daily chart, which we can use to fine tune. We can clearly see that if we start all the way back here in March 20th, the stock was aggressively above our 200-day moving average, now on a daily. Would you have been taken out here? Maybe, because you definitely got closes below it. But keep in mind, what you're going to do is superimpose a monthly chart, a weekly chart, and a daily chart as you fine-tune your analysis to decide to get out. Back here on a monthly chart, you never got to close below the 20-bar moving average. So you could, without any guesswork whatsoever, you could say, I'm going to ignore these closes between the 200 below a 200-day moving average because it's not closing below a 200 on a monthly chart. So we use this shorter time frame, daily, weekly, monthly. We use a monthly to get a big picture if we're going to hold a stock for decades. We use a daily to trade in and out of the stock over, say, a year or two. So from this point right here, March 20th, all the way up to this point right here, March 21, that's a year. We were in a bull market in this stock on a daily chart. No question, we're above the 200-day. Once you get right here, I'm going to question whether the bear market still exists. And if you'll notice, the high here of 175 and the high here of 185 is insignificant. We essentially were over in terms of a bull market on the stock right here in September 20th. The rest of this was just sideways movement. So as you come closer to deciding your exit strategy, you reduce your time frame of your chart. You go from monthly, weekly to daily. Now, if you're a trader and you focus, we spend at RBM Research, we spend almost all of our time on the trading aspects, and so we focus on a daily chart every day. But when you're looking to hold a stock for a long period of time, say for retirement, in this case for 20 years, you use a monthly chart with a 5 and a 20 and a 200 bar moving average, and then as you get close to thinking about getting out of a stock, you switch to a daily chart. And as you can see, a daily chart gives you extreme timing and extreme information very close up front. You can see this would have been a huge warning sign for you to get out of this stock, but this would have been a massive warning sign for you to get out of the stock. And this was the first month that closed below, January 22 was the first month that closed below the 20 bar moving average on the monthly chart, and now you can clearly see that it's closing below the 200 bar moving average on a daily chart. So you get confirmations in different time frames, and those different time frames are critical when you're holding the stock for a long period of time. You also use the same thing when you're using an intraday trade. You use a daily chart, an hourly chart, and a minute chart. It's the exact same thing, but you can use it over, as we just demonstrated, over a 20-year period of time to fine-tune your exits. You get in at a good price and you're trying to hold it as long as possible. If you do that in a day trade and you do it for decades long trades, you just use different time frames. And basically you can almost always do it successfully with a 5, a 20, and a 200 bar moving average. You just change your time frames, and that's what we're looking at here. So we refine or fine-tune our timing by reducing our time period. And in this case, as we said, we're on the daily chart. Clearly, this is a flat market. Clearly, we're violating the 200-day moving average, which is a very important indicator for shorter-term trading, say a year or two. And you can clearly see the stocks topped out. When we got this confirmation here on a 200-day moving average, it closed below it on a daily chart, and then we go to our other chart at the end of the month in January, and we see this stock clearly has sold off like it's done many times since we've owned it. We now know this major term trend is almost certainly over. We could have got out and waited for a place to get out. You don't panic. Wait for a place to get out. And if you're fortunate, maybe get out close to here. And how would you know to get out here? Just because we're guessing? No. The price rallied up and tested the 200-day moving average, which it does here, here. It does it all the time. This was a test that the market generally provided support, and it rallied up to a new high, tested it here, here, here. It finally failed the test here and was unable to penetrate the 200-day moving average from the bottom, and it reestablished itself to a new bull market. So you get in for hopefully at the beginning of a company's history, in this case it's 50 cents, and you get out if you're retiring on the stock 20 years later by gradually reducing your time frames. At the 5, 10, 15-year mark, you're still using a monthly chart. At the 18 to 20-year chart, if you know you're going to retire and get out, you start looking at a weekly chart, but quickly, as soon as you can, you get to a daily chart, because that's going to give you the most reliable indicators on a short-term basis. A 5-bar, 20-bar, and a 200-bar on a daily chart is going to really allow you to fine-tune and be objective and say the market's sideways, closed below the 200. Excuse me, the stock is sideways, it's closed below the 200. Here it's closed below the 200 on a daily and below the 20 bar on a monthly. Now I'm seriously consider getting out of this stock, and again, sell it on a rally and get out. It sounds easy. There's nothing easy to it, but keep in mind this trade that I just showed you on Amazon.com involving the stock market and stocks, technical analysis of stocks and moving averages generated people who did it about $30 million in profits on every $10,000 they invested in the early 2000s. So it's well worth getting some kind of idea how to do it, and it's actually very simple, but I wouldn't say that it's easy to pick it up. We're going to do a series of these videos so that you can review them with different stocks, and we'll go over it over again so that you can tell exactly what we're talking about. Over time, you'll see that it's not hocus pocus. It's a legitimate way to look at stocks both in the short term, intermediate, and longer term by simply leaving the same moving averages on there, the 5, the 20, and the 200, and changing the time frames. That's all we got for you right now. Keep in mind, RBAM Research does algorithmic trading on over 190 stocks. You can get everything we've got, including stocks, forex, crypto, and futures at rbamresearch.com. You just go there and sign up. They're absolutely free. There's a link in the description below. No credit card required, and you can see what we do algorithmically. We put out algorithmically generated trading prices every morning before 7 a.m. Monday through Friday. And if you like this video, please click the like button. If you want to subscribe, please do that. If you have any comments, we'd love to hear them from you in the comment section below, especially if you bought Amazon and held it all that time, made a lot of money. Tell us about it. Just don't tell us how much money, and especially don't tell us your name. Keep in mind, everything you see or hear on here is for entertainment purposes only. You have to use your own judgment, your own analysis. Our entry prices are for entertainment purposes only, as is all of our commentary, and you definitely trade at your own risk.